There is another key financial indication that just today is jumping to an extreme level. We are still getting way too many of these. While on the surface it appears to be calmer this week compared to last week, it doesn't take much to find out that's not the case. In fact, when you look around, you see way too many indications that are similar territory to, say, 2008 or 2020. One of those I always bring up, copper and gold, because of what putting those two commodities together gives us. A sense of financial fear balanced against real economy demand. The copper to gold ratio has utterly plunged, already surpassing 2008 and very nearly cutting under 2020, the most extreme days of 2020. But that's not the one I want to point out here. There's another one similar to copper to gold, though even more telling in situations like these, gold to silver. Most of the time, this ratio is used as a trading signal for when to buy silver. But in these extreme cases, it's about a whole lot more than that. We're talking about deflationary money, liquidations, exceptional degrees of distress. And these are only two of too many. Interest rate swap spreads that had plunged to their own obscene lows last week, they're right back to very nearly revisiting them right now, today. So what is the significance of all these extreme measures? What does it really mean when gold to silver hasn't acted like this other than March of 2020 and October of 2008? And when gold to silver is backed up by copper and most of all interest rate swaps, what does that really tell us? Gold to silver at 102 and climbing doesn't necessarily say that you need to buy silver. What it does say is that we need to pay close attention to the fallout from everything. And now that silver has entered the chat, let's see what the white hot warning from the white metal has to say about all the rest of this stuff. Silver, like copper, part precious metal, part industrial, but silver is more precious metal than copper is. And most often, as I just said, the gold to silver ratio is used as a trading guide. Gold is rising more in price than silver, then precious metal buyers and hedges might choose silver as a cheaper alternative. That's what the gold to silver ratio tells us. But gold to silver does have macro applications. For example, you go back to the early 2010s in the aftermath of the 2008 crisis. The silent depression that developed in the 2010s meant that industrial activity has lagged. It never really recovered, despite everyone saying that it did, and that there was a full recovery by 2018 and 2019 and all the rest that central bankers and economists have claimed. But silver for industrial uses has lagged behind gold, therefore holding silver demand lower, therefore silver prices lower compared to gold. So structurally, the gold to silver ratio has moved higher because there's more demand for gold as the silent depression has worn on and less relative demand for silver from the industrial side. So much so that any demand for silver for precious metal alternative uses hasn't really made up the difference. And then as the ratio stayed above 80 pretty much throughout the 2020s so far. Again, an acknowledgement that the economy never really recovered from the pandemic phase, and the industrial uses for silver haven't made up the difference, with gold continuing to soar ahead. But notice the big spikes here. That's what we're really drawing our attention. We see these huge spikes in the gold to silver ratio in 2020, and especially the worst part of 2008. The summer of 2008 heading into September and October. Lehman Brothers, AIG, Wachovia, all of that. The gold to silver ratio is absolutely surging. And the reason is because gold demand is the error hedge, not inflation hedge, as the error hedge. So it's acting as the ultimate precious metal use in the modern store value sense. Silver, however, while even though it is an alternative precious metal, in these periods, it is being liquidated as industrial leverage holdings are reacting to falling levels of demand, as well as liquidations driven by the lack of monetary circulation and flow, deflationary circumstances. So when the gold to silver ratio spikes, it's a crisis level warning. Huge demand for the error hedge combined with industrial scale liquidations. That's exactly what happened in the worst part of 2008, as well as February into March of 2020. Silver was liquidated, even though it's an alternative precious metal, while everyone piled into gold for what are now very obvious reasons. And so we've seen the gold to silver ratio absolutely soar again over the last week, even since the announcement that the Trump administration was going to delay implementation of the tariffs. This is another signal that has gone in the wrong direction, even following that what should have been a positive signal for the marketplace. When you look at gold and silver, the two precious metals or the two metals have been generally aligned over the past couple of years, going back to 2022, 2023. So the ratio was relatively stable, back and forth around 85 or so. If, again, as I mentioned, structurally higher than where it had been before the 2010 silent depression. But after March 24th this year, silver was liquidated. I mean, massively liquidated, just like copper and other financial assets. Gold got a little bit of a hit, a collateral hit, but a much smaller one, and only on the two worst days, April 7th and April 8th. So since March 24th, silver went down a lot farther and hasn't come back. It's still 6% below its price from March 24th. Gold, on the other hand, is almost 10% above its March 24th price. So the gold to silver ratio has absolutely soared. And between March 24th and now, what have we seen? Significant monetary problems develop in all of these places, as well as the treasury market, the basis trade, foreign reserve managers selling in stocks. All of these signals have been downplayed by pretty much everyone, but now it's all out in the open. The behavior of the gold to silver ratio here in the middle of April suggests that conditions have deteriorated substantially and continue to be deteriorating, such that it's compared to only 2020 and 2008. Now, this doesn't necessarily mean that we're expecting or experiencing something like 2008 or even March of 2020, and I'll get to what all of these signals mean in just a moment. But what it does show is that here's another critical indicator saying all is not well, that what we just went through was indeed a very serious deflationary outbreak, and that most important of all, there are going to be further consequences. Now, before we get back to the rest of today's video, I want to tell you about today's video sponsor. We talk all the time on this channel about the dangers the world is facing, trying to come to grips with the aftermath of the pandemic and the lockdowns, the difficulties associated with the supply shock and price illusion, not to mention still living in the shadow of the 2008 crisis. To put it mildly, there's a lot of systemic uncertainty. Now, I've recommended gold as a store value hedge for years. In fact, it's the ultimate error hedge. But if all you're doing is owning gold, you're only preserving your wealth, not growing it. And that's where today's video sponsor, Monetary Metals, comes in. With Monetary Metals, you can earn up to 4% in their leasing program immediately upon funding your account. And there are higher yields available to accredited investors in their bond offerings. The interest that you earn on your physical metal is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver while you hold them. So join the thousands of investors earning interest in physical gold and silver every month with Monetary Metals. There's a link in the description of this video that has all the information that you need. We thank Monetary Metals for their sponsorship, and now back to the rest of this video. We've already got that message already in a lot of different ways. So here we have gold to silver, that ratio really corroborating in its own way, in its own important way, what we've already been seeing from all these other places. I mentioned copper to gold. That's a big one. Copper prices had been soaring on a supply squeeze up until recently, and gold had managed to keep up with it because of the demand for the error hedge. In fact, when copper peaked on March 26th at what was a record price, gold was relatively right there, so the copper to gold ratio was only up a little bit off of its multi-year low set earlier. But since March 26th, again, that's when all these liquidations, is when the really crisis level proportions showed up, copper was liquidated. It was down 21% between March 26th and April 8th. And during that time, gold went higher, relatively speaking. Only a small decline in those 2 days that I mentioned earlier. So the copper to gold ratio plunged to 0.00862%, which was one of the lowest ratios in the last 40 years. There were only a handful of days in 2020 that were lower. That rate is lower than every single ratio in every single day during 2008 and 2009 and all the years in between. Now, since April 8th, copper has retraced and rebounded by an impressive 13.5%, but gold has been keeping up during that time as well. So the copper to gold ratio this morning, before I started recording, was still 0.00882%, Even with gold today down more than copper. That's an incredibly low ratio, signaling once more same territory as 2020 and 2008, 2009. Same types of consequences and same types of perceptions about the degree of seriousness that we're going through right now. And copper to gold at these levels is a deflationary signal. It's not about, tariffs becoming inflationary as all these central bankers say that they're worried about. It's a solid, dependable, historically validated deflationary signal. In the same way that the gold to silver ratio spiking to this degree and this quickly is the same thing, driven by liquidations and the fear hedge, or the demand for the fear hedge, the error hedge that gold provides. But it's not just these gold-based ratios. It's not just precious metals or commodities. As I pointed out many times before, there is such a compelling story in the copper to gold ratio, therefore the gold to silver ratio too, because of how they're corroborated by the interest rate swap spreads, looking at the world from very different angles, from very different perceptions, and very different uses and needs, and coming to very similar conclusions, including right now. I mentioned that swap spreads, I did an entire video on swap spreads that absolutely plunged to record lows, not just record lows that obliterated all their prior record lows just last week. But rather than come back off those lows, which they have done, they're actually not all that far from the bottom. The recent swap spreads, in fact, the swap spread yesterday and some of the spreads this morning, they would be their own record lows if not for the events of the past week or so. So that puts interest rate swap spreads into the same territory, the same conditions as the worst cases like March 2020, as well as October 2008. But we're not necessarily saying that there's a repeat of 2008 that the market is pricing. It's all about probabilities. So when these signals are similar to those worst case levels like 2020 and 2008, what that says is the probability of something happening is way too high. It's not a done deal. It's not necessarily 100%, but it's enough of a chance that significant chunks of the most important parts of the monetary and financial world aren't willing to sit there and do nothing about it. The chances have gotten to be too high, and those concerns shared by a wide enough coverage of people and participants in the marketplace that these spreads and these prices all move in that same direction. And what everyone is doing is buying increasingly expensive hedges. That's the key here. The price of protection has soared because more and more people see the same thing. More and more participants in the marketplace are on that side of the transaction, yet they keep buying and buying even more intensely. That's what pushes these spreads and these ratios to such extreme levels. Now, it's not an infallible signal by any means, but when we're talking about gold, silver, copper, tips, treasuries, forward rates, and most of all interest rate swaps, that's pretty much the entire ball game. When I say that there's more and more people on that side of the trade, we're talking about a massive coverage all across the real economy, the financial economy, as well as the monetary system itself. More and more people are seeing the same things. More and more people are doing the same things. And by doing that, they're driving the prices of these hedges up. And that's not dissuading people to take the other side of the transaction. In fact, everyone still piles into the same side. It's a powerful, powerful set of signals. And you look at just where swap spreads have been over the last several years. They were already pretty negative in 2022, then took a tumble right at that critical September to October period. And what that said was the market was preparing for the chances that higher for longer were going to get smaller and smaller. That higher for longer wasn't going to be a thing for the long run. Why? Because the entire financial world was betting for interest rates to go lower over time, not go higher and stay there. And technically what they're betting on when it comes to interest rate swaps is the forward money curve, or in this case, the forward SOFR curve. And with the SOFR curve already being inverted, the interest rate swap spread behavior said these market participants were saying the SOFR futures curve, as inverted as it wasn't inverted enough. And by the way, I covered all of this in Eurodollar University's basic series. There's 4 basic videos on interest rate swaps and interest rate swap spreads, what they are, why they're so important, and what their signals actually tell us. So I've got all the information about the basics behind interest rate swap spreads and a whole lot more monetary signals, the curves, and everything else for Eurodollar University members. In fact, that's what Eurodollar University memberships are all about, to fill in these gaps left behind by economics, which does a poor, pitiful, horrible job of telling people and educating the public about how the world actually works. So back in October 2022, that was the marketplace betting the world was too imbalanced after the supply shock, and that the monetary system was too fragile, and that it was only going to get more fragile, not less. The economy wasn't recovering, it was forgetting how to grow. And so while Jay Powell kept screaming strong and resilient, these indications, these creaks and cracks and groans have kept popping up and getting more and more serious all the time. Not just in interest rate swaps, that's a big one, but like I said, copper to gold that's been moving lower all this time. So we have to ask, what are the scenarios that would lead to lower for longer in interest rates, or the deflationary signal that we get from copper to gold and now gold to silver? Scenarios that 2 years ago seemed almost impossible to everyone, but the market said the danger was there and it was still rising. It didn't even appear likely to most people last year, but now you start to see it. Almost everyone can now see it. And what is it? It's the probability that something is going to go wrong and then keep going wrong. That something happens that leads to something bigger happening, and then so on and so on. The cascading effect in markets, but also the real economy. The soft landing, for example. The chances were never great according to the marketplace and have only gotten worse, while everyone outside of the marketplace says it's only gotten higher. So the swap spreads and copper to gold ratio told you this entire time, forget higher for longer, forget the soft landing. Fragility is rising, and therefore the growing probability of consequences of that fragility, of that lack of recovery. It was the entire system, with everything riding on the outcome, disagreeing with Jay Powell and the mainstream. So what they were saying is the probability for something like deflationary money was already too high entering this year. And now that we've seen these liquidations and all of these extreme levels and all of these important measures, what they're saying is the chances have gone up for even more of the same, including even more fallout and more consequences across the financial system in terms of volatility, potential liquidations, but also real economic damage up beside all of that. And these probabilities, you'll notice, they go mainly in one direction, not in a straight line, but an unmistakably singular progression in the wrong direction. Going back to 2022, when everything changed, when the world transitioned from the price illusion of recovery to forgot how to grow. And what these probabilities are really saying is that forgot how to grow, the chances are it's not going to stay forgetting how to grow, that it's going to complete the cycle in full and complete fashion and all the consequences that go along with it. So when the gold to silver ratio was soaring in the summer of 2008, right on through October 2008, what was the outcome of that? Not only do we get a crisis and a massive global contraction, more importantly, the silent depression which followed from it. That was the probability hedged into that ratio, the copper to gold ratio, interest rate swaps, and all the rest of them. What were the consequences from 2020 when, again, the ratios soared or copper to gold ratio plunged and swap spreads plunged along with them? Everyone said the recovery afterwards was robust. It was too hot. There was a labor shortage. The markets told you that was all an illusion. The forgot how to grow economy and the increasingly fragile monetary system that went along with it. These probabilities are about how the 2020 pandemic era ultimately plays out. And at these exceptional levels, crisis levels already, what that tells you is the probabilities are indeed very high in the wrong direction. Because if they had managed to hit the soft landing, it would have validated the technocratic approach that governments could just turn off economies, then turn them back on and everything would be good. And if it wasn't good, they could easily cover the damage with all their transfer payments and government borrowing. So you can see why politicians and central bankers keep sticking to strong and resilient soft landing. They're entirely invested in the outcome. But not hitting the soft landing, completing the cycle fully, that would mean they did screw us all over in 2020. There was and still will be massive damage that everyone has to pay for, and that none of their genius plans worked as advertised. Instead, all they had been were harmful distortions that created the illusion of recovery and economic health, all the while the foundation was cracking and rotting away. That's all the forgot how to grow economy really was, telling you the foundation was cracking and getting more and more unstable, more fragile. That's what these markets have been betting the entire time, that instability and fragility was going to lead us back to the consequences for 2020. Now that they're all betting at these extreme levels that we've only seen in 2008 and 2020, what are the chances of a soft landing and that Goldilocks scenario? That's what these numbers and comparisons really are, a place to start answering that question. Another one of these key financial warnings comes to us from Japan. I don't necessarily mean the yen, though that's part of it. I went over the details of what this was and what it says in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and Eurodollar University subscribers. And until next time, take care.